You run a UAE company. At some point, you may decide to pay yourself. The question is not simply how much. It is what you call the payment, how you support it, and whether that classification holds up if reviewed. Salary or dividend. For UAE corporate tax purposes, the difference is material. And getting it wrong can affect more than your next filing. Start with the legal form of the business, because it determines which rules apply from the outset. If you own an incorporated business in the UAE, for example, a mainland or free zone LLC, the company and the founder are separate legal persons. That separation is fundamental. It means the company can pay a salary, bonus, or employment benefit to the founder, provided the founder genuinely performs work for the business. A sole establishment is treated differently. Under UAE corporate tax, the individual owner and the sole establishment are generally regarded as a single taxable person. That means the owner cannot pay themselves a salary and claim it as a deductible expense for corporate tax purposes. The issue is that there are not two separate taxable persons on both sides of the payment. What appears to be salary is, in substance, an owner withdrawal, and it is generally not deductible. The distinction between salary and dividend is simple in theory, but often misapplied in practice, which creates real tax risk. A salary, bonus, or employment benefit is compensation for work performed. It is paid because the individual contributes to the business in a defined role. A dividend is different. It is paid because the individual is an owner and is entitled to participate in the company's profits. For a UAE company, founder salary may be deductible, but it must be more than a label in the accounts. The company should be able to show that the founder performed genuine work, that the amount is commercially reasonable, that the payment was properly recorded, and that the position is supported by adequate documentation. Dividends and similar profit distributions are not deductible for corporate tax purposes. That is not a penalty. It reflects the nature of the payment. A dividend is a return on ownership, not a business expense. The classification must follow the substance, not the tax outcome the company prefers. The risk increases when the person receiving the payment is the founder, shareholder, director, or officer of the company. In that position, the payment is not presumed to be independent. If reviewed, the company may need to show that the amount and character of the payment are consistent with what independent parties would have agreed. This is where the related party and connected person rules under UAE corporate tax become directly relevant. Related party transactions must be on arm's length terms. Payments or benefits to connected persons may also be limited to market value and must be genuinely incurred for the business. In practice, the company should be able to demonstrate a few key points: what role the founder performs in the business, why that role is genuinely required, how the salary, bonus, or other remuneration was determined, and why the amount is commercially reasonable. A year-end payment created mainly to reduce taxable profit, with no commercial basis or approval trail, carries a high risk of challenge. Equally, a dividend recharacterized as salary solely to generate a deduction is a misclassification, and one that may expose the company to tax adjustment and penalties. The substance of the payment, not its label, determines its tax treatment. A well-maintained founder remuneration file does not need to be complicated, but it should be complete, consistent, and prepared at the time, not reconstructed after a question is raised. For salary, bonus, and employment-related payments, the file should include an employment contract or service agreement, a clear role description, payroll records, and bank payment evidence, a bonus calculation where applicable, and market benchmarking or comparable support. For dividends and profit distributions, the file should include evidence of available distributable profits, board or shareholder approval, and payment records and bank transfer evidence. The practical test is simple. If the FTA, an auditor, an investor, or a buyer reviews the file without your explanation, the nature and basis of every payment should be clear. Salary versus dividend is not just a choice between two payment options. The right position depends on the legal form of the business, the substance of the payment, the documentation, and the UAE corporate tax rules that apply, including related party and connected person rules. For founder-led UAE businesses, remuneration should not be treated as a year-end journal entry. It should be structured, properly classified, and supported before filing, then reviewed as part of the ongoing tax compliance process. At Audiix, we help UAE businesses build clean accounting records, review corporate tax positions, and document owner remuneration correctly. From the outset, not after a question is raised.